Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about valuation and why a thoughtful discussion of your comparables matter. And it starts with the idea that investors calculate valuation multiples. Investor relations officers and corporates provide information and context for those calculations. And by extension, a good discussion of your comparables is going to give you some short attack insurance. Just look at Equinix and the Hindenburg Research Report today. So let's start with this idea that there's three general ways for an investor to value a stock. It starts with a discounted cash flow analysis, or DCF. The second is a relative valuation method, which is probably the most common. And third is this idea of creative valuation, which is synonymous with what Peter Lynch talks about in sort of One Up on Wall Street. So let's start with this idea that relative valuation is the most common. Well, there's four benefits that you can get from having a thoughtful discussion of your competitors. First is credibility. If you have a good, thoughtful, nuanced discussion of competitors, it's the easiest and fastest way to gain credibility with investors. Second, if you're providing relative information about you and your competitors, you're helping drive better informed relative valuation calculations. Third, if you're providing that narrative context, you're helping those investors identify valuation discrepancies around your company and others in that relative valuation process. And finally, relative valuation is just really easy and it's done by everyone. So the more informed you are, the more ability you will have to impact your share price. And so why do corporates not want to talk about competitors? Well, it's about downside risk and gentlemanly rules. If I'm an executive, I don't want to be seen as calling out another executive or another competitor just to have that executive or competitor call me out. And if you do a thoughtful and nuanced approach to this discussion, you actually will get a lot of benefits that will offset any downside risk that you can think of. And here are the three learnings. Remember, investors create comp sheets, which are focused on identifying the right relative valuation metrics and where are the valuation discrepancies. Investor relations and corporates are focused on building a football field. Who is the competitive set, and what are the key inputs I should be using to drive a relative valuation? And then third, the comps listed in your proxy statement matter. Be thoughtful and be mindful about who you list as your competitors. It means a lot and signals a lot to investors. Thanks for watching. Always here to help with your capital markets, investor relations, and corporate finance needs.